Hello friends, I'm Manoj. I'm currently pursuing my MBA in Sri Venkateswara College of Engineering, Bengaluru, which is affiliated with VTU Belgavi. So in this video, I'm going to discuss about regarding security analysis and portfolio management. And the topics are meaning of bonds, types of bonds, future of bonds, and examples. So, what is bond? A bond is a fixed income financial instruments that represents a loan made by an investor to borrower, typically a corporation or government. So the borrower agrees to pay back the money on a specific date called the maturity date. So along with this period, interest payments called coupon payments. So in simple terms, you lend money to an organization and they promise to return it with interest after a fixed period. So the types of bonds is these bonds can be classified into different types based on the various criteria. So based on issuer, there is government bonds which is issued by the central or state governments and it is low risk and low return. So for example, government Indian government securities, that is GSECs, are US Treasury bonds. And second is corporate bonds, which is issued by the private or public companies. It is high returns and also but high risk than the government bonds. And third bond is municipal bonds, which is issued by the local government bodies or municipalities, often tax exempt. So, and it is based on the security. There is secured bonds, and it is backed by the specific assets of the issuer, and it is also less risky. And second is unsecured bonds, which is debentures. It is not backed by the assets, and it is also riskier and depends on the issuer credit rating. So third is based on the coupon payment. Under this, it is fixed rate bonds, which is paid a fixed interest rate throughout the bond's life, and floating bonds, interest rate which is varies based on the market conditions like repo rates and all. And third is zero coupon bonds, which is no periodic interest and also sold at a discount and redeemed at face value. And fourth is based on convertibility. Under this convertible bonds, it can be converted into shares of the issuing company. And second is non-convertible bonds, which it cannot be converted into shares, but it have a higher interest rates. And fifth is based on duration. So under this, short term bonds, medium term bonds, and long term bonds. So these short term bonds maturity period of less than 5 years, and medium term bonds, it is maturity between 5 to 10 years, and long term bonds, it is maturity period of more than 10 years. And examples to understand these bonds are: imagine if you buy a corporate bond from XYZ Limited and the face value of that bond is 1000 and the coupon rate is 8% annually, and the maturity for that bond is 5 years. So each year you will receive 80 rupees of 8% of 1000 rupees. So after 5 years you will get your 1000 rupees back. So futures of bonds is face value, that is par value. So in this the original value of the bond repaid to the investors at the maturity period. And second is coupon rate. So it is the fixed interest rate paid by the issuer to the bondholder. And the third feature is maturity period. It is the time that after which the bond amount, that is the face value, is repaid. And the fourth feature is issuer. So in this the entity that issues the bond, example the government or any of the company. And the fifth is yield. So in this, the return an investor earns from the bond, including the interest rates and credit rating. So in this, an evaluation of the bond issuer's ability to repay and market price. So in this, the current trading price of the bond, which may differ from face value, and the convertibility. So in some bonds, it can be converted into shares, which is convertible bonds, and security. So in this, the bonds may be secured, backed by the assets, or unsecured by the debentures. So this is, and the conclusion is, the bonds are essential financial instruments that helps the government as well as companies in rise of capital while offering a investors a stable and predictable income sources. And understanding the features of bonds such as coupon rate, maturity, risk levels, and it helps the investors make wise investment decisions. And different types of bonds are, it serves a various investment goals. Some prioritize safety while others offer high returns with higher risks. So in conclusions, these bonds are versatile and valuable component of any of the financial systems and also portfolio, balancing risk and return for both issuers and the investors. So this is the end of the video, and thank you everyone for watching this video. Please do like and comment. Thank you.